From New York City for our viewers worldwide, I'm Bonnie Quinn in for Shanali Basak. Bloomberg Real Yield starts right now. Coming up, Chairman Powell delivering a dovish outlook, giving the green light to markets and sending yields lower. And U.S. high-grade sales passing $500 billion for the year. We begin, though, with the big issue, Powell aiming for a soft landing.
Chair Powell particularly stuck to the narrative that we have been hearing for some time.
The reiteration of data dependency.
I said over and over again, it depends on the data.
That would be their guide in terms of when they see the green light for moving to cuts.
I wouldn't go as far as to say the bias is cut no matter what the data looks like. I mean, the Fed's still committed to trying to get inflation down to 2%.
The base case remains a start in June, 3 cuts this year.
The committee was pretty split between 2 or 3 cuts.
It was really much closer to a 2-cut scenario.
I think this is a signal.
The threshold to cut is a little higher than it was prior to this meeting.
They will tolerate slightly higher inflation for longer.
We still think we're going to cut rates this year. Timing's uncertain.
This is a Fed that really wants that soft landing to continue.
Jay Powell, he wants to ease policy.
I have the unfortunate view of kind of viewing him as a bartender still pouring drinks. I think we haven't heard last call yet.
So let's take a look at how many rate cuts the market is actually pricing in right now. As you can see, it's changed quite substantially just in the last few months. A little bit of a tortoise and hare situation, if you like. Back here, we thought there might be 7 cuts in 2024. Turns out maybe it's going to be a little bit slower than that. Right over here, as you can see, we're now pricing in about 3.4. So just still a little bit more than the Fed is anticipating. But let's take a look at when we might see those Fed cuts. So the odds of when the Fed might cut, very different from just a few weeks ago. Let's take a look at the odds for May, June and July. As you can see, only July is still actually being priced in. That's the yellow line right here. That's the only certainty the market is willing to express right now. The blue line, which is the June odds, that's still below 1. And obviously, we have practically priced out any cuts in May. So now let's hear directly from Fed Chair Jay Powell himself with his take on where rates are headed.
We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks.
Joining us now is Mary Ann Bartels of Sanctuary Wealth and Matt Diczok of Bank of America joining us. So, Mary Ann, thank you for joining, and Matt, you as well. After having seen what we saw this week, are your thoughts on where we're headed rate-wise any different? Mary Ann.
As for me, no. I mean, the Fed has been very clear in their process since last year. And what's amazing, as you pointed out, the market continues to look for rate cuts. Especially last year, we thought we were going to have rate cuts, and we didn't get any. Yet the equity markets did very well. The fixed income markets did have a little bit of bucking. And we still have some of that bucking in the fixed income markets now. But the equity markets are not paying attention to that at all because we have earnings. And although rates are important to part of the valuation of the markets, I think, are really riding on earnings in the anticipation of the productivity enhancements of AI. But we are expecting that rates come down. But I would agree, if the economy remains strong and inflation remains sticky, we may not get those 3 cuts, and it might only be 2. But given the presidential election year, I would expect at some point in the first half we do get a rate cut.
Matt, to that point, GDP growth this year will be a whole lot higher than the FOMC estimated in December, according to Fed members. We have higher core PCE, and we have lower unemployment, and we also have looser financial conditions. In that environment, why should the Fed cut at all?
That's a great question. We talked about inflation being a little bit stickier than people expected, labor market being a little stickier than people expected. But these 3 rate cuts, they are also stickier than people expected. We heard from Powell, you heard from all the commentators. It's clear. January, February, bad inflation prints didn't happen, not a problem. He still wants to ease, still wants to get consensus on the committee to ease. So why, Bonnie? Great question. 2 reasons. Inflation is a lagging indicator. It tells you what happened, not what's happening, and not what's going to happen. So there's always a lag with the inflation data and the economy. But more importantly, there's definitely a monetary policy lag. The 10-year just peaked around October, November of last year, not even 6 months ago. The Fed funds rate just peaked in July of last year. It takes 12 to 24 months for rate hikes to actually impact the economy. So if you're looking at a lagging economic indicator like inflation and the rate lag, the stories about rate cuts not working, way premature. Come back and talk to me first half of 2025 to the back half of 2025 and tell me if rate hikes haven't worked. So they've gotten the soft/no landing. They're going to continue to play for that. With 170 million people in the labor force, every 1% increase in employment puts about 2 million people out of work. It's worth playing for.
Well, that's just it, Mary Ann. I mean, if there is a lag, and we're not quite sure how long that lag is going to be, how much pressure will the Fed chair feel under to make a cut in order to avoid the scenario that, plays out if the opposite of what Matt just said happens?
I don't think the Fed is under any pressure, actually, to have to cut rates. And, Matt is a great fixed income portfolio manager and strategist. Hello, my friend. We worked together back in Bank of America. I think, there are lags, but the models have changed with all this monetary stimulus, going all the way back to 2008 and 2009, zero interest rates, the balance sheet, growing and then growing again through COVID, and then going back to zero interest rates. It's really the Fed, and I don't think anyone really knows how to model this. How does all this monetary stimulus offset the rate hikes? And we haven't even talked about, quantitative tightening. And how is this impacting the economy? And what are those lags? So I really do feel that the Fed will be very data dependent. I mean, right now, the Fed looks good and they want to stay looking good. They want to stick this landing. But I do think that eventually we will get rate cuts. It is a presidential election year, even if it's one or two, but they may not be simultaneous. There may be months in between the rate cuts. But I still think that the whole environment for the fixed income market and for the equity market really remains very robust. This is a very good investing market for clients and to really build out a diversified portfolio.
Matt, to that point, I mean, the bond market has been more volatile than the actual economic data in recent months, right? What happens if we do get some kind of weak economic data point? I mean, just this week alone, we've repriced on the 2-year. We're back below 460, where we were above 470 just 5 sessions ago.
We agree. We think, if anything, there is potentially downside risk to rates. Now, Mark Cabana, Megan Swiber, our wonderful rates research team at Bank of America Research, feels about 4.25 is probably where we're going to end the year. And we obviously agree with that as a baseline forecast. But we do feel we're in a very good place for fixed income. We're still at like 2% real yields approximately. And if you look back over the last 20 years, that's quite attractive. A 10-year in the 4 to 5% range, actually, over the last 20 years is quite attractive. So we believe that if there is increased volatility or downside economic risk, bonds are going to do really well for you here. And happy to be here with you and Mary Ann as well. A good friend, and I learned a lot from Mary Ann in my career, so happy to be on with all of you here.
Exactly. It's a reunion to an extent. So, Matt, where would you be buying in the curve at the moment?
So what we really like to do is focus more on sectors. We're going to be overweight a little bit on rate risk, treasuries, agency mortgage backs, a little bit underweight on credit risk, including municipals, investment grade credit. It's not that we don't like that or we see credit risks. They're just pricing in 0% chance of economic weakness. That's a little tight for us. We don't think you have to stretch now in fixed income markets to get decent real and nominal rates, so we're not going to. If anything, though, we want to be kind of slightly long duration. So the most important thing for our clients is getting them to the right duration. A lot of times they're several years short to what they should be. So get clients their strategic duration target, be slightly longer, but favor rate risk, don't favor credit risk as much right now.
And Mary Ann, let me ask you the same thing, given that you're also pretty much a proponent of tech companies as well. And I wonder, which is the more attractive opportunity here?
Well, to be very honest, I think equities are going to outperform the fixed income market, but they traditionally do. But for clients that are looking for income and want to reduce the volatility, especially if they own, the cyclicals and the very volatile parts of the market, we continue to recommend to add duration to the portfolio. We wouldn't go over benchmark. We would be at least at benchmark. We still think these are good opportunities in the market right now to actually add a little bit of duration. And we know a lot of clients are sitting on the sidelines in cash. They still like to collect that 5%. But if the Fed is going to cut rates, at some point, they're going to lose that 5%, and they need to understand that.
Okay, a word of warning there to finish up with. Mary Ann, thank you so much for joining. Mary Ann Bartels and Matt Diczok, thank you also for joining. Next up, the auction block. U.S. high-grade sales passed $500 billion for the year, for the fastest pace ever. We'll get ahead of the 5-year average if we continue at this rate. We dig into credit and the issuance boom next. This is Real Yield on Bloomberg. I'm Bonnie Quinn. This is Bloomberg Real Yield. Time now for the auction block, where global issuance remains red hot. We start in Europe, where Morgan Stanley and JP Morgan were the first Wall Street banks to raise money this year in the region. Morgan Stanley had a €5 billion sale over 3 parts, and JP Morgan sold €2 billion. Here in the US, high-grade issuance from the likes of United Health, BAE Systems and Campbell Soup helped to drive yearly sales past $500 billion, and that is the fastest start to a year on record. And in high yield, this month is likely to finish as the second busiest March in 5 years. This year only surpassed by 2021, when support measures put in place during the pandemic caused a surge. Sticking with credit, Earl Davis of BMO Asset Management explaining why he has a neutral stance.
We are in a mature business cycle getting closer to the end. The spreads right now we feel don't adequately reward individuals for owning them, in high yield particularly. Right now we're neutral credit, and we're getting close to going underweight credit if we get even more euphoria in the market. And the reason why we're here is that there was just so much cash on the cash lines. We saw how many trillions were in money market accounts, that as long as there's relative stability in the market, and we're seeing that with the resilient market, people have to put that cash to work.
So let's bring in Zach Griffiths of CrediSights and Colleen Cunniffe of Vanguard. Great to have you both, and thank you so much. Same question to you both. Why aren't high-yield issuers taking advantage of this bond bid here? Colleen, let me start with you.
Yeah, well, I mean, as you just heard, they are actually. We are seeing issuance year to date that's exceeded last year's, still relatively flat on a net issuance basis. But I do think issuers that are in good financial positions are trying to take advantage of it if they have a need. That being said, a lot of issuers took advantage a couple years ago of good market conditions, to get their balance sheets in order. And so there's not the demand, there's not the need yet necessarily on the part of a large swath of the high yield market. It may be coming, but it's not quite there yet.
Should people be taking more advantage of this bid, Zach?
We think it's a very strong opportunity, but when you think about what the Fed is signaling it's going to do, what we've heard from central banks this week, except for the Bank of Japan, is rates are going lower. And so I think there is a bit of patience and perhaps expectation that even though spreads are tight, we could see yields moving lower. I think that's a bigger consideration for investment grade companies, but something that high yield companies are considering at this point as well.
So, Colleen, talk to us about where in investment grade is attractive to you right now, given everything that's been going on in the bond market, the amount of issuance, the amount of appetite for this issuance as well.
Yeah, well, and as you mentioned, so there's been an incredible amount of issuance so far this year. At this point, we're almost at 50% of the expectation for the year as a whole. So we continue to view the market as relatively attractive, and we think we're set up for some pretty attractive technicals in the second part of the year. In terms of sectors that we've been interested in, there's been some good performance out of the E&P sector. We're focusing on the pharma sector, and then a little bit in defense as well.
Zach, are spreads wide enough here for you to be interested in those sectors, maybe specifically, but also, other areas of the market, because spreads have come in quite substantially?
Yeah, Bonnie, spreads have tightened a ton, and we're through our year-end target on the investment grade and high yield index. And where we still see value is in financials. Spreads are still wide. We have a little bit of a lingering effect from last year's concerns over the regional banking crisis. And so when we talk to our sector analysts, financials really stick out as where the opportunity remains, where we could really see that additional 10 to 15 basis points of tightening, which could push the index a little bit tighter than where we are today. But when we think about the balance of risks, we see more catalysts for a widening drift for the remainder of the year, or perhaps more stability, and see limited room for further spread tightening, just because we have tightened in so much. We've seen extremely robust demand, and we look for volatility to pick up when we get into the summer months and are focused more on the election, which can cause more volatility in markets.
Zach, when you say financials, is it specific pockets of financials, and what kind of spread, what kind of risk premium are you looking for out of them?
So we are overweight banks, both large U.S. banks and regional, and we're also overweight the insurance sector. And when we think about where spreads could go, as I mentioned, maybe another 10 to 15 basis points tighter. And if we get that kind of spread move, I think that's where we'd really think about where we are from a strategic perspective and shift to a more neutral allocation to the asset class broadly. But when we look for risks in the near term, especially now that we've gotten through the March Fed meeting that everyone was focused on, we had a very rosy forecast from the Fed with rate cuts still coming, even though we have higher growth, higher inflation, and even a lower unemployment rate than previously anticipated. So we do think that it's a solid backdrop for markets. And when we talk to clients about spreads being very tight, they're like, yields still look very attractive, both from an investment grade and high yield perspective. And that seems to be driving market sentiment more than tight spreads.
Colleen, if you're not really expecting, large spread widening and higher yield credit, would you look to something like the financials to pick up a few basis points?
I think you just mentioned higher yielding credit. I assume you mean high yield. So I don't think that would be necessarily where we'd be looking in that market. Right now, I think we generally view most of the high yield market as you said, pretty tight on a spread basis. And even when we look at the CCC part of the market, a lot of that spread that you find there is being driven by some pretty idiosyncratic names. So every time I'm on here, I mention that Vanguard Credit Research has a very fundamental driven bottoms-up approach. So we're doing our selection work and picking through names rather than focusing on a particular broad sector.
Well, another really interesting area that I know you focused on is emerging markets, and I'm curious as to how that narrative changes once the Fed does start to cut.
Yeah, well, so as you know, the emerging market is a longer duration profile, so it has the benefit, potentially globally from that kind of action. Earlier this year, we saw some issuance that moved spreads a bit wider. Now that seems to have come back in, and things appear pretty fairly valued. And most of the market, again, like high yield, where you're finding opportunities is on the CCC side, which is all about selection.
Zach, anything that Colleen is saying there, does it resonate with you?
Yeah, I think the credit selection focus, especially if you're willing to move down the spectrum, is very important, is going to remain important. There are plenty of idiosyncratic names out there driving the sector. If you go back to 2023, CCCs outperformed, and to start the year, you're seeing strong performance as well. But when we think about where risk really could start to show up in the market, that's what we're focused on. And so I think, we are still overweight high yield from a strategic perspective, but we think when positioning a portfolio tactically, you need to be cognizant of these risks. And I think when you look at spreads as tight as they are, I just mentioned that clients are more focused on yield. I think the risk return gets a little bit less appealing down the credit spectrum.
Zach, Mohammed Arian was on this morning, and he was really putting out some warnings out there, that there are elements to this market, both equity and credit markets, that remind him of the mid-2000s. And I think he would just be probably a little bit cautious, about deploying money in general. Is there anything about this market that makes you or your clients uneasy?
It's interesting you bring up that time period. We went back and looked at the first summary of economic projections that the Fed put out in October of 2007. They were looking for, inflation around their target, as well as growth in the 2.5% to 3% range. And we all know how that turned out. And so it does seem like there is a lot of confidence in this market. And when you think about if everyone's looking in one direction, let's say equities higher and spreads tighter, you need to consider what are we missing. And the thing that we keep coming back to is there is a ton of cash in the system. So even if we do see some bumps in the road, there's plenty of cushion to manage through that. And so right now we think things look pretty good. And if the Fed's forecast ends up being correct, that's a great environment for financial markets and the U.S. economy as a whole.
So, Colleen, I think one of the potential catalysts for sort of a negative event that Mohamed El-Erian is worried about is something to do with geopolitics, right? And there's a lot of geopolitical issues that are hot right now. Is there anything in the credit world that would be extremely affected in an adverse scenario?
On the geopolitical front, as we've seen, as we've gone through some of these issues, ultimately, in the U.S. markets, it's going to depend on whether it's going to have a direct impact on the U.S. market, whether that, the most obvious there is in the energy sector. More broadly, the risks to the current situation, I agree with what, Zach was saying. The real risks are if inflation doesn't come in where the Fed is hoping it comes in, and, that could delay or even put off rate cuts.
All right. Thank you to you both for joining me today, and much appreciated. And hopefully we'll chat again, very possibly before the Fed does its first rate cut. That's Zach Griffiths and Colleen Cunniffe. Still ahead, the final spread the week ahead. The Fed's preferred inflation gauge is going to be in focus. This is Real Yield on Bloomberg. I'm Bonnie Quinn in for Shonali Basak. This is Bloomberg Real Yield. Time now for the final spread the week ahead. Coming up, well, on Monday, we're going to get more data. New home sales, plus Atlanta Fed Raphael Bostic will speak. We're going to get more Fed speak during the week, as we'll see later on, but more data then coming up on Tuesday, U.S. durable goods and the all key consumer confidence figures. The Fed will be closely watching those. Again, more Fed speak, as I said, on Wednesday with Chris Waller, who obviously has been pretty outspoken. And then we do get some earnings as well. Thursday, all eyes will be on the Sam Bankman-Fried sentencing. Prosecutors have asked for 50 years. His team says that's only suitable for a supervillain. Friday, we'll get US PCE. And for my final thought, let's take a closer look at those estimates for PCE. As you see, deflator, core deflator, expected to come in as the prior months. We just will be looking for a little bit of an increase in the core PCE deflator month over month.